Let's talk about the numbers behind some of the strength in technology. Caroline Woods joins us for a look at Marvell and Okta. Let's start with the hardware. Good morning, Caroline. Salesforce, obviously.
Hey there. Good morning, Oliver.
Salesforce having a great morning. Okta's not having a bad one. It's kind of come in a little bit. So let's go to Marvell, given the chips, 18%. I mean, this is incredible.
Yeah, especially considering how much it was already up year to date. So now if you take a look, it's currently up almost 90% year to date, a huge beneficiary of AI. This was a beat on both the top and bottom line. The chipmaker also issued an upbeat, strong fourth quarter guidance, so that's likely helping shares today as well. Just running through the numbers, adjusted EPS of 43 cents came in 3 cents higher than what analysts were looking for. Revenue grew 19% sequentially, 7% year over year to $1.52 billion. The expectation was for more like $1.45 billion, driven by strong demand from AI. So if you take a look at data center revenue, $1.1 billion, that was up 25% sequentially, quarter over quarter, up 98% from the previous year. But if you take a look at the revenue growth of only 7% year over year, that's because enterprise networking, carrier infrastructure, consumer, automotive, industrial, all lower year over year. Enterprise networking down 44%, carrier infrastructure down 73%, and so on. So weakness there being offset by strength in data center revenue. In terms of the outlook, Marvell said for the fourth quarter, we are forecasting another 19% sequential revenue growth at the midpoint of guidance, while year over year we expect revenue growth to accelerate significantly to 26%, marking the beginning of a new era of growth for Marvell. In terms of the actual numbers, Q4 revenue is expected to come in at $1.8 billion, plus or minus 5%. Wall Street was looking for $1.65 billion. And then Q4 earnings of 59 cents, plus or minus 5 cents. Wall Street's estimates were for 52 cents per share. So even minus 5 cents, that estimate or that forecast coming in better than the estimates. Marvell said, we look forward to a strong finish to the fiscal year and expect substantial momentum to continue into fiscal 2026. Now, as we talked about yesterday, as Marvell was reporting, the majority of analysts very bullish on this name. More than 90% rated it as a buy, but it closed yesterday above its median price target. So no surprise, we're seeing a lot of adjustments, a lot of price target hikes on Marvell. The median was 95 before the report. It's now $120 per share. We saw JP Morgan raise to 130, saying it catalyzing a multi-quarter period of positive EPS revisions, so expecting more. Citi raised to 112, views Marvell as the top custom application-specific integrated circuits compute play into 2025. And then we saw other analysts with even higher price targets, Benchmark up to 135, Rosenblatt up to 140, and so on. So a plethora of price target hikes, and we're seeing Marvell inch closer to some of them, up to almost $115 a share right now, up about 20% following this report.
Really amazing stuff, and kudos to some of those analysts who were early on Marvell as the next best way to play AI after NVIDIA. I think this is a really big deal because we saw so many chip makers struggle in the second half of the year, and names like AMD, of course, Supermicro on its own merits or lack thereof, and a lot of breakage in the sector. Even Qualcomm and Broadcom were both kind of stuck for a while. So the fact that Marvell is carrying the torch now in a way that few other semis outside of NVIDIA or TSM have suggests it really is right in the middle of the highway that's being built.
Yeah, and that seems to be the case, hence why, despite these really impressive year-to-date gains, that still more than 90% of analysts look at this as a buy. So it's, the company pointed out that they're a huge beneficiary of strong demand for AI, and they don't see that slowing down based on the outlook that they offered and some of the commentary that they offered in terms of significant growth, especially sequential growth like they've been seeing. Obviously, it's offsetting some of the weaker areas of the business, but this is, in terms of this report, it's all about the data center revenue, really.
Yeah. I mean, I'm kind of surprised that Dell is not moving on the day. A few of their close corporate ties in the data center side. They had the big move in the first half of the year, so maybe this is just kind of the realization of which stocks were underpriced from a valuation perspective, and it does though argue pretty solidly for Dell and a few others. All right, let's talk Okta. Definitely a stock-specific story, but it does seem the numbers for the sector are very helpful. They're also kind of in the right place still for security and enterprise software. Seems like they've actually got some good trajectory again with their customers after a pretty bad year and a half.
Yeah, and we're seeing shares rally after this report. I will say it's a bit disappointing. A 5% rally is nothing, to
they've come
ignore. But initially, it looked like they were going to pop even higher, and we had talked about last night, maybe they'll turn positive year to date. They were poised to, and unfortunately not the case right now because 5% is more modest than what the futures were actually looking like. So still down about 6% year to date. We'll see if Okta can make up for some of those losses. But quarterly results came in above expectations. They also issued upbeat guidance. Running through the numbers, as you can see here, adjusted EPS of 67 cents, 10 cents higher than the estimate. Revenue, meanwhile, rose 14% year over year to $665 million. The expectation was for under 650. Subscription revenue was up 14% year over year to $651 million. RPO, the subscription backlog, was at $3.66 billion. That's up 19%. And then current RPO, so basically that's supposed to be recognized within the next 12 months, was up about 13%. I talked about the upbeat guidance for the fourth quarter. Okta is projecting total revenue to grow between 10 to 11%, so $667 million to $669 million, and then current RPO experiencing a growth rate of 9% year over year. And then for the full year fiscal 2025, the company now expects total revenue of $2.595 to $2.597 billion. That represents a growth rate of 15% year over year. Should note that on the press release, they did say all of these periods for the guidance factor in a challenging macro environment. I will say the majority of analysts still in the hold camp for Okta. If you take a look, about 56% of analysts are on the sidelines for this name. But the median price target went from $92 to $101. We saw a ton of price target hikes for this name as well. Stifel to $115, BTIG to $110, Morgan Stanley to $106. So Okta currently trading around $85 per share right now. So quite a bit of upside according to quite a few of these price targets. But the majority of analysts sticking with the hold ratings.
All right. Comeback story, maybe not quite as springy as the one for CrowdStrike was, but eventually it seems kind of the similar conclusions that customers like the product and largely want more of it, not less of it. So if they kind of get out of their own way and prioritize some of the financial improvements, which it seems they have now, the earnings side of it seems particularly important because the top line is just not quite going to get back to the highs. So similar with a lot of these software companies, nice when they start focusing on the bottom line. Last one here, Caroline. Let's talk Foot Locker. It's just unrelenting pain for this company.
Not saving the best for last with this one. This is what happens when you disappoint and you slash your guidance. And we're seeing Foot Locker shares getting punished this morning, down about 17% following this report. I guess the good news is that it looked like they were going to be down more than 20% ahead of the open, so not quite as bad as it maybe could have been. But it was a miss for both earnings and revenue. They slashed their full-year outlook, indicating a really downbeat holiday season. The CEO, Mary Dillon, said consumer spending trends softened following the peak back-to-school period in August, and also the promotional environment was more elevated than anticipated. So if you take a look here, adjusted EPS of 33 cents came in 6 cents worse than what analysts were expecting. Revenue fell 1.4% to $1.96 billion. The expectation was for $2 billion. Same-store sales were up 2.4%. Inventory was down 6.3%. Now, looking ahead, Mary Dillon said, while our trends in early November landed below our expectations as consumers held back their spending ahead of the holiday season, we saw a meaningful and positive acceleration over the key Thanksgiving week period, especially in stores. So that sounds a little bit upbeat. But despite the strong performance, she said, we are taking a more cautious view and are lowering our full-year sales and earnings outlook due to a more promotional environment and softer consumer demand outside of key selling periods. So in terms of that lowered full-year outlook, adjusted EPS now expected to be $1.20 to $1.30 for the full year. Previously, that was $1.50 to $1.70. Wall Street was looking for $1.53, so also well below what Wall Street was looking for. Sales are now expected to decline between 1% and 1.5%, whereas previously they were expected to decline, or the range was down 1% to potentially up 1%. 1%. So the conference call was still going on last I checked, so no analysts weigh in yet, but the majority were already on the sidelines. Almost 60% rated this as hold, about 19% rated it as sell. So we'll see what they have to say following this report, but definitely getting punished in terms of stock price. Trading below $20 a share now, down more than 17%.
Wow. Just brutal. Probably got to keep cutting stores. I think just that's kind of my default for all these retailers that are still struggling in 2025 is just, I don't know, throw in the towel to some extent. It's just clearly
they have that
too much financial burden.
plan. Yeah, the lace-up plan has to do, they're kind of re-innovating the store footprint and such. So they did talk about some progress that they've made on that front. We'll see if it, translates into the numbers. We should also note that Nike is actually lower today as well, not by nearly as much, but Nike shares under pressure, down almost 2% today as well.
The lace-up plan, that's cute. Loop, swoop, emphasis on the pull of the plug. All right, thanks, Caroline.